Concepts and inclusions retyped and cleaned into a clear outline. Hash. Individual income taxes. 49E. Chapter 4, Gross Income, Concepts and Inclusions. Callbacks. 1. The qualifying child test doesn't include an income test. Even if Jasna made $100,000, if she didn't provide half her own support, she would be eligible for the credit for other dependents. 2. This credit, and only this credit, specifically adds under 24 and a full-time student to the age test for dependent child. 3. If she wasn't a student or was 24 plus, she would need to use the qualifying relative rules. Tax formula gross income, less, deductions and exemptions equals taxable income, tax owed, from tax tables, less, tax payments and credits equals tax or refund due. What is gross income? Except as otherwise provided in this subtitle, gross income means all income from whatever source derived, including, but not limited to, the following items. 1. Compensation for services, fees, commissions, fringe benefits, similar items. 2. Gross income derived from business. 3. Gains derived from dealings in property. 4. Interest. 5. Rents. 6. Royalties. 7. Dividends, etc. What is not gross income? Gross income does not include the following. 1. Returns of capital, e.g., if I pay $500 to buy an item and sell it for $600, only $100 is taxable. The other $500 is return of capital. 2. Items specifically exempted from taxation by Congress, e.g., scholarships for qualified expenses, tuition waivers, life insurance proceeds at death, etc. Exemptions. All income is taxable unless Congress specifically exempts it. Examples of taxable income. Mize. Tom works at Walmart and steals $50 from his register. Jim finds oil in his backyard. Paul finds $10,000 in a piece of furniture he purchased and can't find the owner. Kirsten wins a sweepstakes and receives a new car as her prize. Knowledge check activity 1. Question. Peter had purchased common stock of an unrelated corporation for $20,000. The stock is sold for $25,000. What is Peter's gross income under the recovery of capital doctrine? A. $25,000. B. $20,000. C. $5,000. D. $15,000. Answer C. $5,000. The recovery of capital doctrine means sellers reduce gross receipts sale price by the adjusted basis of the property sold to determine gross income. Taxable year. Like financial accounting, taxpayers can use a non-calendar year. Unlike financial accounting, the choice can be arbitrary, but records must be accurate. Accounting methods. 1. Accrual method follows financial accounting rules with some modifications. 2. Cash method. Income taxable when received, deductions when paid, with some caveats. 3. Hybrid method, often used by small businesses. Most items use cash method, but inventories use accrual. Income realization. Income must be realized to be recognized, taxable. Realization event, provision of goods, services, or control over income. Does not have to be cash. For property, realization is transfer of ownership. Special accounting methods. Installment method allows gain to be spread from an installment sale. Contractors may use percentage of completion or completed contract method. Change in method requires IRS consent. Special rules for cash basis taxpayers. Constructive receipt, income recognized when available without restriction. Special rules for accrual basis taxpayers. Unearned income or advance payments may defer recognition if the same method is used for tax and financial reporting. Creates timing differences when financial reporting requires multi-year recognition, not available for rent, interest, insurance premiums, and some other advance payments. Non-cash exchanges. Exchanges not involving cash are treated as if cash was exchanged. Example, I do my neighbor's taxes in exchange for him painting my house. Tax law treats both as if cash was paid received. Case example, Bob owns 100% of ABC Inc. and his personal home. ABC needs a loan, so Bob transfers his home to ABC to use as collateral. Bob keeps living in the home. IRS asserts Bob has gross income since he continues to live there. Questions. Is IRS correct? Mize. How much gross income? What is the character of the income? Does anyone get a deduction? Ownership of income. Income is taxed to the person who earns it. If I direct my paycheck to my son's account, it's still taxable to me. The transfer is a gift. If my toddler earns $1,000 in a commercial, the income is hers. In employment, income from services belongs to the worker, but wages are deductible to the employer. Income received by an agent, income received by the principal. Constructive receipt. Income is recognized when earned and available without restriction. Legal doctrines. Substance over form. IRS and courts look at the transaction's substance, not labels. Examples: refundable versus non-refundable deposits. Employer paying me but labeling it as payment to my son. Economic substance. Transactions with no purpose other than avoiding tax will be ignored. Arm's length transaction. Related party transactions scrutinized closely. IRS may recharacterize based on what unrelated parties would do. Example: Jenny owns Saints Corp. She pays herself $300,000 salary even though CEOs in similar businesses earn $100,000. IRS may reclassify part of her compensation. Would you like me to also turn this into a condensed cheat sheet style summary? Key terms, formulas, and doctrines bolded.